Hello and welcome. My name is Jan King. I'm a senior fixed income product specialist at Allianz Global Investors, and I'm pleased to welcome our CIO Core Fixed Income, Carl Papo, today.
Thanks, John. It's great to be with you today.
Carl, as CIO Core Fixed Income, you oversee assets under management of $50 billion. Your team manages a wide variety of products with different risk tolerances and objectives. Can you give us an introduction to the team setup and the philosophy?
As you mentioned, we manage approximately $50 billion in assets, a wide variety of client objectives and clients, if you will. We're managing assets for pension plans, insurance companies, and then a number of mutual funds that are retail or institutional oriented. I think the product we're going to talk about today is on the more conservative end of kind of the objectives that we meet. Very fortunate to work with 25 very experienced investors on the portfolio management side, and then also work with a number of other teams within Allianz Global Investors. In particular, our credit research effort, which is 23 analysts that are globally located, as well as 18 traders, which are also a global trading desk. Most of our clients' objectives are going to be met with investment-grade securities, which is what we typically focus on. Much of our focus is around security selection, which is what we'll talk a little bit about today, really understanding the companies we invest in and then the specific sectors that those companies may be within. And as I mentioned, research and trading is definitely a big part of our process and embedded in the process as well.
In our conversation today, we would like to focus on one product that you manage that has got a lot of attention recently. Allianz Global Floating Rate Notes Plus is a short-term credit fund that has gained more than $1.3 billion of inflows so far this year. Carl, why is it that the fund has gained so much interest?
Yeah, it's a good question. We've seen a lot of interest in that product the past 2 years. There's been a tremendous amount of flow into more conservative, we would call them front-end products, products that don't have a high level of sensitivity to changes in interest rates. So we would think of this product in the way it's marketed and positioned is it's really an alternative to bank deposits in conventional money market funds. Those types of investments are very stringent. Also very conservative. Our fund is a little bit more flexible, and as a result, we typically offer a slightly higher yield than those products might. Additionally, we do offer daily liquidity in a mutual fund. So it's a very liquid product. It's very conservatively run, and then it's predominantly very high-quality securities. Typically, the fund will have 80 to 90% in investment-grade securities. I think currently it's about 90%. It's a very stable product, and the principal in your investment is going to be very steady. The income will go up and down, but the price that you pay for the fund is going to be very, very steady. And I think we'll talk about some of the features that drive it to that. It's a very well-diversified product. It's invested in a number of different sectors. We do invest in government securities as well. We have an excellent track record. We launched the fund 7 years ago, and we're proud to say that we've never had a year we've had a negative return in the fund, and that's with some difficult years in 2002 in particular. And as we spoke a little bit earlier, it really benefits from a lot of the resources at Allianz Global Investors, and credit research is certainly one of those.
Maybe for those who aren't familiar with the segment, could you explain to us how a floating rate note works?
Great. That's a fun question. I'll try not to be too technical in my answer. Maybe you can help me out. So if we think about it, most bond funds and most bonds are very sensitive to changes in interest rates, right? And if you buy a bond fund and interest rates go up, the experience we saw in 2022, prices will decline at points in the cycle. They can decline a lot. A floating rate instrument really is an instrument that isn't very sensitive to changes in interest rates. So maybe I'll explain a fixed rate bond and a floating rate bond to kind of make that comparison. The floating rate notes are probably less than 5%, so it's really a niche market. A fixed rate security bond, which is the majority of the securities in the bond universe, maybe we'll use an example. IBM issues a 5-year bond. So the maturity is going to be in 5 years, and the prevailing interest rate at the time is 4%. So that bond will have a 4% coupon. So IBM is making a loan for 5 years, and they're going to pay a coupon of 4%. If that security is issued today, in a month's time, if interest rates have gone up by 100 basis points and the prevailing rate is now 5%, the price of that security has to go down to ensure that it gives you a 5% yield. So your coupon will stay at 4%, but your price is going to go down. This is the sensitivity to interest rates. If IBM were to issue a floating rate bond for a 5-year term with a 4% coupon, the difference is that floating rate note, the floating component of it would go up or down. So if interest rates would go up by 100 basis points, the coupon would adjust and it would go to 5%, and the price of the bond wouldn't change.